talk about today?
Okay, no, we always keep it simple. Hi, everybody. Thank you for being here. I'm Bonnie Halper. I write the weekly startup one-stop newsletter. I'll put the link in the chat, although I'm publishing now on Substack as well. And always has my little editorial on the industry and always useful links for entrepreneurs. And every 2 weeks, we host a breakfast, an on-team breakfast with one investor and a small self-selecting group of entrepreneurs and investors. We have 2 investors here today. And we want to thank Glenn is our guest today, and he will introduce himself. And he's welcome to go around the room and have everybody introduce themselves first, or he can introduce himself. But we want to thank WorkChew for hosting us. And Joseph, why don't you tell us about WorkChew?
Sure. Good morning, everyone. Joseph Katz, representing WorkChew today. WorkChew helps people find and book flexible workspaces in hotels, restaurants, and empty office spaces across the U.S. We partner with hospitality and office venues and turning their underutilized space into a network of on-demand workspaces. You can visit workchew.com to learn more. Thank you, Bonnie.
Very nice.
Glenn, when you're traveling, you can have a little home away from home. So tell us about you and the fund, and even about your our backgrounds back to Web 1.0. Or would you like people to introduce themselves first so you know who's in the room and who you're talking to? It's up to you.
Sure. If everybody wants to just do a quick roundtable, that's great. Just, I mean, why not? I'm going to do the same.
Okay.
So
David, you're the first one here. Introduce yourself.
Okay, I'm David Robson in Baltimore. I'm doing a startup a couple of years into it in the education area, partnered with one other ex-teacher. We are supporting students and teachers in mathematics education K-12. My partner developed a method of working with students which dramatically improves their ability to retain the math that they learn in school. And as a consequence, at the state exams at the end of the year, things get a lot better because they have not forgotten. Forgetting is an underappreciated universal phenomenon in education establishment. And it turns out that psychologists, not educators.
David, we do try to keep them short. It's
okay. All right. Well, okay. So that's enough.
Okay. Thank you. Alicia, welcome back. Oh, you're muted right now.
Yes, good morning.
Okay.
Good morning, Bonnie. Good to see you. Good morning, everyone. My name is Alicia Overton. I am the founder of the AO Planner Company. It is now official, Bonnie. It is official. I am solving the problem of centralizing scheduling, brainstorming, and notes into one location using a 4-in-1 planner along with hopefully in the future, technology will be married to it. So I love coming. This has been a great experience coming to Breakfast with an Investor because at some point I will fundraise. So I love to hear the ideas and thoughts of investors. So
thank you.
Great to be here.
And thank you. And Saren, you joined us.
Yes, exactly. I may, still have to take a call in between, but I'm happy to be here always. So I'm based in Switzerland. I have private banking background, so I do wealth management services from Swiss Private Solutions. And then I also work with startups for strategic partnerships and business development.
Thank you. June, good to see you. Since you've been moderating some... Oops, somebody.
Hi, everybody. My name is June Choi. I'm a managing partner of Serval Ventures. We are an emerging tech and infrastructure venture builder and investor, and we're trying to evolve venture investment because I come from a background in change management, strategic consulting, and I think it's not quite sustainable with so many new VCs coming into the market. The deal flow is getting crappier. And so we're working on trying to make startups more investable. We like to get them very early stage, really work with them to help them understand what they need to do to get to capital. We're building out an advisory portfolio. We'll be raising a fund once we build a small portfolio. And then we're also doing global pilots to develop a global network, currently working with Vietnam. Last year worked with South Korea. And Bonnie and I have been working with our first portfolio company, which is a dynamite founder.
Yes.
And we're shifting her into a transportation data company.
But somebody's capturing these days. Tara, it's good to see you again too.
You too. My name is Tara Todros Whitehill. I am a visual storyteller, and I have an agency devoted to helping social impact organizations tell their stories better. And because everything we do these days is visual, and I think especially in the social impact space, they don't do it very well. And so I help them do that. And it's not just photo and video. Visual storytelling is everything from presentations, animation, data visualization, social media, newsletters, you name it. Most of the things we touch these days are visual, and we need to keep people's attention. So yeah, that's what I do. And the work out of Istanbul, work internationally from, India to Los Angeles and everywhere in between. So I'm excited. I always like to learn how people scale and what people do, and just kind of expand my information so that I can help more people with this.
So Glenn, you get more than a few minutes.
It's what's funny is I love when we do those going around the table things, because I bet everybody here has the same problem, which is a good problem to have, but we're always, each time one of you would talk about what you're doing, what you're working on, my immediate mind goes to, oh, I could connect there, or that fits into something else. And like, that just sort of is the mindset of everybody who lives in the spaces that we're all occupying. So it was funny going around the table, I can just relate or connect or remember when I did, or whatever it might be, with pretty much everything that was said.
I bet nobody would turn you down either.
Well, yeah, I got some follow-up to do already just from that. I mean, every single person, I think there was something that I can connect to. So please send me an email after, and we'll follow up, because I'm sincerely mean that. Little bit on my background. So I was talking a little bit before we kind of got rolling, just on the craziness of how you get into, my path to venture is, I don't think, normal at all. I mean, maybe it is, but I certainly came at it from an operator's perspective, and my path to become an operator in technology was certainly not normal either. I don't believe. I kind of laugh that I go back, Bonnie and I both go way too far back, I got involved in technology in pretty much the early 90s. I was mentioning before, for those that were on the call, apologies to back up a little bit, but I launched as sports marketing. I had played college basketball, and my wife's cousin was a professional football player who got injured. And so the two of us, along with another guy, formed a sports marketing company. We did a lot of stuff around, we built a lot of technology into the solutions we had, but that technology had nothing to do with like the World Wide Web, because it really didn't exist in any commercial form at that time. And then in the mid 90s, I ended up taking a job that I can't fully explain in a tech company that was a startup that was focused on building a sports website, and built that up to a large size, and then ended up developing a technology within that company that would serve advertising banners so that we could actually make some money and pay our staff, and went from making no money to literally making millions of dollars a month in a series of 6-7 months. And so we found product market fit, I guess would be the argument, and we hit a very serious inflection point. And 2 years later, that company went public, and that kind of launched my technical career. And since then, I've launched an additional 13 startups, and I exited 9 of them, which is a really nice way of packaging or saying that I failed miserably on 5, but everybody overlooks that. Like everybody, you know, it's, I guess it's a good batting average, but startup life is tough, right? And I had 3 public offerings out of the 9, which was a big deal. And I did a bunch of turnaround work for some of the biggest hedge funds in the world as well in that time. So I was a guy who kind of came up and ends up in technology, does a bunch of startups, does a bunch of turnarounds, runs some public companies. And in that window of time, I became a pretty active investor. And I built, you know, everybody on this call knows what it is, but 20 years ago, nobody knew what a family office was, but I launched a family office and I had a staff and I constantly would go against their recommendations. I always wanted to do the early stage, like new startup, the worst possible risk mitigation strategies on the planet, but that's what I liked. And so then how'd I get into venture? Well, about 7 years ago, I was at a family office conference at Stanford University. And a lot of times at these conferences, you'll have entrepreneurs that they bring in because it's all that anybody's really interested in, even though they never want to invest in them. And we can talk about that for the entrepreneurs on the call and how you can change that dynamic maybe. But I really liked the entrepreneurs, and I was sitting at a table with like all the Northwest fans. I'm in Seattle, right? So, and I'll get to where I launched Quake. I launched Quake. I decided I want the worst commute of all, so I launched Quake in New York because that made a lot of sense. But I'll talk about that too. But so I'm sitting there with the Weyerhaeuser family, reps for Gates, McCaw, you know, just some of the biggest families, honestly, from the Northwest. And I said, why, you know, these are great. Why don't we invest in some of these? And you hear the same things you hear all the time about early stage with particularly family office investors. Too early, too hard to do the due diligence, you know, the check size is too small, you know, whole lot of things. And it's like, well, what if we could actually do that? What if we could build a fund that focused on things that families are interested in, and if we could solve some of those problems you're talking about, work, you know, so your teams don't have to do that. And the families at the table and some other families there gave me their 1 month landscaping budget for their 8th vacation home, and we were off to the races. That's how Quake started. So then I suddenly had put my foot in my mouth and I had to build a fund, and it took me about 12 months. I spent a lot of time thinking about where I wanted to launch. That's how we ended up in New York. I thought it was the new up and coming. I didn't want to be in the Bay Area. I think June said something earlier that I totally agree with. You know, we're a value player. How we attack venture, we're definitely look for a mismatch between traction and growth and opportunity versus valuation. And that wasn't going to happen in the Bay Area at the time. So for us, that had a big impact. And then looking at ecosystem, it just seemed like, I mean, New York's so obvious anyway, but it was just on the rise at that time. I mean, Bonnie, when we first launched Quake, you know, we bumped into each other there, and, you know, again, a lot of shared background, and we were both, I remember talking about how it just felt like something was about to pop there. And so we launched there. I had a data analytics background, everything I did. Okay. So once I got out of sports marketing and launched an ad tech company, basically, from that point forward, everything I did was data science. And I became an expert on it. After 9/11, I was kind of in the lost and found business, or the hide and seek business. I was doing a lot of work with DHS, traveling, went to Israel with Tom Ridge, was doing a lot of work with NSA. So everything I did from the time that I was heavily engaged in tech as an entrepreneur to the time that I was doing work with the DoD, NSA, and others, all of that was data science. So when I attacked venture, I attacked it as a data science problem. Well, this is important because when we attack, when we look at an investment, we work very hard to remove our bias. We built a bunch of AI tools, and a lot of funds say that, but most of them are just full of baloney, because when you look at their founder pool, you can tell they don't really use AI. I'll explain that. But If you look at our investment ratios inside Quake, we have 261 investments. I'll talk a little bit just about some of the numbers because it'll probably be helpful. We have 3 principal funds. We have 7 total. Some of those funds, some of the 7 are, special purpose vehicles, follow-on vehicles. We have a deal that we've done. We work with Deutsche Telekom out of their headquarters in Germany, and we do investments around 5G. But we have 3 principal funds that are generalist funds. Those funds have a total of 261 investments, about 150, give or take 145 markups within the fund. We have the funds themselves are up about 2 to 2.5x at this stage each. But the biggest thing for us, we have about a 92% survival rate 5 years in, which typical survival rates in venture are between 35 and 65%. 65%, by the way, it's more industry tied. So if you're in fintech, for those founders out there, if you're in fintech or insurtech, your survival rates are a lot higher than if you're in some other fields. But our average, and we focus on things families focus on. So we're in infrastructure, logistics, transportation, manufacturing, agriculture, really a broad spectrum of things. With a very high survival rate, but we bring new technologies into these old line markets. And before everybody joined, we were talking a little bit about how important it is as a founder to focus on your market, your opportunity, right? So we focus on huge, old mainline markets that have lots of buyers, lots of capital, lots of problems that have been around. We're joking about holes and drills. People have needed holes for a long time. They don't necessarily need a cordless drill. There's lots of different types of drills, but they definitely need holes. And so if you stay focused on these problems that are going to exist for a long time, you're going to do a lot better. So that's what we do. We tend to focus there. And then we try and bring cutting edge technology into those things. But we do that by applying this artificial intelligence tool that I'm not going to talk a whole lot about because it's quite a differentiator for us, but it basically helps us attack one of the things you were talking about, June, which is finding deals and finding this mismatch between value and valuation. We basically have a tool that scrapes the web. It ties against databases, like Crunchbase, Angel, F6S, Gust. So we have the universe of all the startups, and then, or at least all those that are talking about being startups. And then we look for signs of traction in the real world. And then the tool basically reaches out and asks these startups to apply for funding. And we quantify and qualify the scoring of the traction. And we're looking for some really specific things when we look for traction. And from that, what's interesting is we end up with about 10 times more female founders than most venture funds, about 10 times more Black founders than most venture funds, 6 times more Hispanic founders. Like, we have no focus on diversity whatsoever, but we're in a ranking of 3,400 early stage funds in 2021 from Crunchbase data, taking out the funds like Halogen that focus on women or Backstage that focus on Black founders. So taking out all the niche funds that focus on really specific aspects of diversity. We came in #1 as the most diverse fund, the most supportive of diverse founders out of 3,400 early stage funds. So I'm pretty proud of that. Not, again, because we focus on merit. And that has served us so well, both in terms of finding value. I'll give an example of that the women on the phone should be mad as hell from this example. It's a story with a happy ending, but you should still be mad as hell. I think, Bonnie, you might have met Fran Meyer. I don't recall if you met Fran. Fran was the former founder over at Match.com along with Gary Crimmon. Gary was on one of my boards years ago, and I didn't even know they knew each other. But Fran was a Bay Area-based Stanford alum, launched Match.com, Woman.com, and Trustee, the cyber verify site, right? So she's had 3 solid wins, 1 huge win. She had a company doing $50,000 a month in revenue, was raising at, I think at the time, a $3.5 million valuation with her current venture. and she couldn't get anybody in the Valley to give her money. Now, I don't think it's so much she's a woman. I think that at the time she was a 56-year-old woman. I think that what people often forget is that there's lots of bias. It's not always obvious, and age is a definite area of bias as well. So she had 2 strikes. Man, that's a great investment for us. We found that we very rarely hunt in the Bay Area because of the value. You know, again, we're looking for a lot of traction relative to valuation. And traction's not always revenue. We can talk about that, but it's not always revenue. There's other elements that can play out. But now she's doing like 700, 800,000 a month in revenue. She's off to the races. But nobody would give her money. And that's a lot of what we find. And then I'm going to kind of just shut up. I'm going to close out, and then we can talk about whatever anybody wants to talk about. I mean, I'm like a wind-up toy. You can take me anywhere, just like Bonnie. You can do whatever you want to talk about. But what's fascinating to me that I've learned a lot from the data is, and I think everybody intuitively knows some of this, but so if you take, we've got a lot of Black female founders. What is it? Project Diane does an analysis every year, I think it is, on how many, particularly women, but Black female founders, one of the categories, you look at how many Black female founders have raised over $1 million. It's a really sad number, a really sad state of venture. I think when I started, there were a total of 30 5 years ago. In our first year, we had 3 of them. Like 3 of those founders that we were the first check in ended up raising $1 million. Now I think the number's closing in on 200. I might be off. I don't think I looked at the most recent report. I think I might be 6 months behind right now. But it's still a really stunningly low number. But one of the things you determine that's sort of fascinating is that if you take different buckets, and again, it can be age, it can be gender, it can be race, it really doesn't matter. If you take different buckets of diversity, and you look at somebody like me, not so much now because I'm 56, but if you take somebody like me at 35, and you take every dollar that I can raise, and then you take one of our, in the case I was just talking about Black female founders, they can raise 17 cents from friends and family on average against the dollar that a 35-year-old white guy like me can raise. And I'm not a diversity guy. I'm not really talking about this from a diversity perspective. I'm talking about this from a challenge perspective. By the time we even get to look at a founder like that, there's, you're talking about self-selection for this call, Bonnie. By the time I look at the founder like that, they've been through the ringer to get to me, right? And they've been so efficient and bootstrapped and figured stuff out. And by the time, and when I write it, and we write first checks, we're pre-seed seed, we're 150,000 on the first check. We're generally speaking 250 to 500,000 up to $1 million on our second checks, our follow-ons. But we're almost always the first check. We almost always now, when we started, nobody co-invest with us because they didn't know who we are. We just had family offices, a ton of them. We had 75 on our LP pool, but we didn't have funds. Now, 5 years in, everybody, there's literally nobody I can think of that does a big name that doesn't invest with us. But we fill these with syndicates, but we started. We're the first spark, right? We give them that check. They're so efficient with that check. And so it's fascinating to see how this, again, it's a data. To me, it's all data because I'm a data scientist. So I just get hung up on some of the lessons we learn as we go, some of the things we learned in terms of our sourcing and finding value. And it reflects, again, I'm proud of our diversity, but it's not because of our diversity. I'm proud of our diversity because it reflects in our 92% survival rate 5 years in. And the other day I got a question about that because I was mentioning to some who were on the call that I did a keynote out at Notre Dame the other day, and I got a question about, well, how many of those are zombies? No, I mark them off. If you're a zombie, like if you're just kind of cruising along flatline, no, I mark you a 0. So when I'm talking about 92% survival rate, I'm talking like legit 92% companies growing 5 years in, which is just unheard of. And that's because of the data. So been very, very fortunate in that regard. We got some amazing founders. One final comment though, and because it'll probably spur some dialogue, we don't actually focus on founders first. And I think vast majority of venture does. it's a matter of opinion, but Startup Genome, again, if you believe in data, the Startup Genome reports about the definitive source. They look at over 5,000 startups every year. They take, deep dive polling on what it was that caused the startup to fail, what worked, what didn't. What you find is that founders they're really important, don't get me wrong, but like a lot of the things that people focus on with founders don't matter that much. So, where you went to school affects whether they can raise money, but it doesn't affect survival rates or success rates. How old they are. There is actually a little bit more to that one. Primarily because if a founder has tried before, even if they failed, they're more likely to succeed than if they've never tried. So second time, third time. But there's a lot of things we think about: gender, race, location. Everybody talks location. Location actually doesn't really matter. Not to say there's not some outlying huge opportunities that happen in some markets, right, that are driving a lot of that viewpoint. But again, I'm a data guy. I'm just about the data. And if you dig into the data and look at it and you kind of extract yourself from it, extract your bias from it, you find that a lot of these things we focus on don't really matter. So we look at traction first because it's the one meritocracy. It's the one thing that is absolute, we can quantify. Then we look at team. Generally, we're trying to invest after the first major pivot in the company, because the reason we do that is because about 22% of all companies fail to navigate that first pivot, and I don't want to pay for it. We think we know how to identify it. I don't often get into a lot of detail about that, but we think there are very specific tells, and when a company has achieved that milestone, and they're going to see a serious inflection point in growth after that. But if they've done that, we already know they have a pretty good team, because they had to be able to navigate what was a very tumultuous time. So we look at traction, then we do look at team, and finally we look at tech or product. And I was joking for those founders on the call, I was joking before we got started here. Founders have a really bad tendency, and I think a lot of us who look at pitches know this, to talk about their product, and you should. But your product isn't your business. So when you get an opportunity to pitch somebody like me or many of the others on this call, definitely want to talk about your product and your journey. Definitely want to talk about your own, what I call the hero's arc. You want to talk about your own, journey, the golden fleece journey that you took to build this thing. Why'd you do it? How'd you do it? The heroic story. But I want to know about the business itself. That's really where the disruption lives. What is the problem? Why is it lasting? What makes you unique or special in attacking that? And why are you going to achieve, or how have you already achieved, product market fit? Because, it's an overused buzzword, but it's absolutely critical. It is the single biggest indicator of long-term viability and success, without question. Depending on how you want to slice, dice, or boil the terms used in Startup Genome, product market fit, because they use founders come up with lots of different ways of explaining how they failed. But if you dig into it and look at it, more than half is tied to failing to build something that people really wanted, which is all that really is. So I would just say those are the messages you want to convey. When you talk to somebody like me, you really want to let us know about the market, the opportunity, the disruption, and the longevity of the solution and the problem set. And then, Bonnie, with that, that's like, I know I covered a lot of things, but I was just trying to throw hooks that people can tie into, and then we can talk about anything anybody might want to talk about.
I wanted to mention, I read just this morning that GV has decided to dispense with using AI to vet deals. And I'm wondering, considering what you just said, if it's because they were coming up with too many women and minorities, founders, and yeah, they just announced it today.
I hadn't seen that.
I'll send it to you. And I'll have Joe introduce himself, since he was late here, and he was like you, he loves data, and so does Jude.
Oh.
Both very data focused. So Joe, introduce yourself.
Yeah, sorry I was late. Joe Milam here. Glenn, you and I connected a number of years ago. I'm here in Austin, and Fernandez, who's ran your Quake program out here, I know pretty reasonably well. Yeah, my background, I ran a multifamily office, was a securities analyst and portfolio manager, and used only data. We managed money off a dashboard. Third-party data, architected very specifically based on Charlie Ellis's work of Greenwich and Associates. We were from 96 or 09, we're the #1 large cap core manager in the United States based on absolute and risk adjusted returns. So process orientation, data driven, take your own ego out of it. It works. What we built is a platform to literally be able to execute that same level of dashboard from a dashboard, never meet an entrepreneur, manage a venture strategy optimally, just data driven. You know, I've been working on trying to fix how we fund innovation for over 25 years. And I always just do the contrast. When we did our own securities analysis, yet the managements of GE and Cisco and Intel and IBM, they didn't have to come parade to my office and pitch me before I decided to buy the stock and put it on our clients' portfolios. Because they reported properly, they had to, and that allowed data vendors to scrape that data and then present it in the way that, you know, so you could manage data. So that's really what we've done, is we've just dissected what's available in the public markets from a data and process orientation and replicated that to manage a venture. Whatever your venture thesis is, you can do it from a laptop, never meeting with the entrepreneur.
You know, I think I just saw you posted recently in LinkedIn, Joe. I just connected. I hadn't realized it was you. And you were responding to something somebody had said about getting together with founders. And you're like, I don't see why we have to do that. I remember now seeing that just the other day. That's funny.
Well, and if you know Danny Kahneman's work, the behavioral economics guru, you know, he did a wonderful presentation at the CFA Institute's annual meeting in Beijing or Hong Kong in 2018. He was a keynote, and his presentation was brilliant. He says, look, it's not hard to understand why algorithms beat human bias, right? Quant strategies, basically data driven, but simple algorithms beat complex ones. And that's a profound topic. And if you incorporate sort of the Malcolm Gladwellian philosophy that he wrote about in the book Blink, if you limit yourself to 4 data points and a narrow time window, you're going to actually optimize the portfolio of decisions you make on that subject matter. And each chapter of the book is just simply different industries proving that point. As long as you have the right 4 data points and you limit your decision making in the blink of an eye.
Yeah, this is how we. Yeah, it's funny. That's actually how we attack the inflection point. So it's sort of funny to me to see that. We think it's a very tight window. Because frankly, in our case, it's tight for 2 reasons. I believe in what you're saying, but then on top of that, there's a massive jump in value, like awareness and valuation jumps in that window of time so sharply that we don't have the luxury of sitting on it either in our particular case.
And that's the point. I mean, if you know what you're doing, and that's the assumption in Gladwell's book, is that the right piece of information only in the hands of an experienced professional. Now that is I think the fly in the ointment in the whole venture model is very few people actually know what they're doing. They wouldn't know what the right 4 data points are. So they default to social signals, who else is in the deal, party rounds, crap like that, because they just get caught up in the social optics. That results basically in FOMO. Right.
June said something in her intro that you know, I was talking about how, like, when everybody went through their intros, it's so natural for everybody on this call to immediately think of like how they can connect those dots. And she said something that really resonated for when I went back and was starting Quake, because now for a little bit different reason, but in my case, I'm just an entrepreneur. And I think one of the superpowers of an entrepreneur is, I always joke with my founders, it's like, you don't know, forget about, you know, thinking outside the box. You don't even know where the box is or what it looks like.
What box?
Exactly. So when I attacked venture, to me, I wasn't trying necessarily to disrupt. I'm just a chaos maker to begin with. Like, I just came in and said, okay, how would I do this?
Right.
I didn't really look at how everybody else was doing it. I knew that I needed to play to my strengths. And so it's sort of funny how we attack that, but I do believe that, you know, that venture is ripe for disruption.
It's happening. Sequoia made their big announcement last fall of changing their model. And in that announcement spoke of how the venture industry is operating under the business equivalent of floppy disks. Such a great quote. That was from
Yeah,
Sequoia.
that was a great line. Yeah.
Oh, and Bessemer changed, and actually General Atlantic and Andreessen before, even before Sequoia, had changed very quietly. But the industry is changing. And if you haven't seen it, there's a great report called The Future of Venture Capital. It's freaking brilliant. I'll put it in the box. It was Clayton Christensen, Mr. Disruptive Innovation, his consulting firm InnoSight, that he had that side hack. They were hired by a deep pocket in Singapore to study the venture industry, just a classic consultant engagement to study an industry before somebody decides to spend a lot of money in it. And that was done in 2020. Report came out in 21. And it's absolutely brilliant.
Huh, I haven't seen that. I'll have to look at that one.
I'll put it in the box. But anyway,
I appreciate it. Yeah.
It speaks to all the same things, right? It speaks to all the stuff we're talking about. And it talks about data-driven and the rise of the venture studio and the more data-driven, more index-like venture portfolio strategies. I mean, in the public markets, active management versus just allocating capital in an index-like strategy, that's long since been sorted out. There's very little actual quote unquote skill. You understand skill versus luck and how to actually, the consultants can dissect in an active managers how much of their performance was just due to luck and how much was actual skill. There's actually ways to calibrate that in the public market because you have a data feedback loop called pricing and relative and absolute performance. So there, but in doing so, you can isolate what's luck and what's skill. And let's just say that the entire venture industry, largely, I'd say the entire, that's too generalization, 90% of the venture participants, whatever alpha they create by their venture investing is luck. If they create alpha, it is luck.
Well, then you can get into what the markups are and how they're getting there. And why, there's a whole lot going.
You think? Yeah, it's just a mess. I mean, that industry's never settled on a standardized performance computation like the public markets has what's called.
That's an important point too. For again, we got some founders on here, and I'm always talking to my founders that there's a lot of kind of the dark arts of venture that are not necessarily well known, and so a lot of times when you're talking to, and I think it was Alicia was talking about this, when you're talking to venture, they're thinking about, sometimes are they out raising capital? Are they out raising a new fund? Are they going to be raising a new fund in a year's time? Or some of these things that probably wouldn't seem like natural things to ask or talk about become relevant in how they view the next set of investments they're going to make. Are they trying to drive up their internal rate of return so they can raise more capital? Are they looking for things that'll maybe have a serious amount of appreciation over the next 6 months versus next 6 years?
Right.
Like there's a lot of, and I don't spend a crazy amount of time with my founders because I really want them to build good businesses, but they need to understand what they're walking into.
Yeah.
When they meet with a fund. I don't know where this came from and what you're saying, Joe, but I am curious what other people think, what the other funds. Bonnie, you're always so, I told you this, and I mean it sincerely. Like we all get a ton of newsletters, and there's a ton of them that I don't really, if I'm being fair or honest, I don't really read, right? I mean, maybe I'll catch them every few times, but I always read Bonnie's, and that's not because I'm on here. That's truth. But part of it is because Bonnie, there's no sacred cows.
That's right.
Like Bonnie's like, she's happy to attack or endorse or whatever. She just goes from where she actually believes, and I think that's really powerful. And one of the areas that I was curious, I imagine you've got an opinion about it, Bonnie, but again, we've got so many diverse founders in our fund. So we spend a lot, even though we're not focused on diversity, we do spend a lot of time looking at a lot of the moves that are happening in that way for the founders that we have and how we can help them. So obviously there's some funds who are specialized in and I tell my founders, because we actually I've had one of our founders he was like, I don't want to go to this fund because then people will think I just got funded because I'm Black. And I'm like, well, that's stupid. I'm like, if you're a crypto company and you don't go to a crypto fund, that's pretty dumb. If you're like, if your focus is on ag tech and you don't go talk to a Nova in Memphis, that's pretty dumb. So if your focus, if you've got somebody who's really, they believe their thesis is they can do better in performance by investing in certain founders, you should absolutely go talk to them. They want to be supportive. So those funds, to me, they've been out there and doing their part. But what's been troubling to me, and I'm curious where you land, Bonnie, and others, like I saw Google Ventures, and I got to be careful here because these are all co-investors of ours, but I saw Google Ventures and some other really large funds launch what I would call sliver funds. And I'm saying that because it would be the equivalent of me launching a $15,000 fund in relative ratio. Launch these sliver funds focused on diversity. And my question was, why? Why not instead just improve your process and invest from your primary funds? And I'm just curious, am I missing something there? Is that like, I don't get it.
It's the equivalent of ESG. It's greenwashing. It's optics.
That's what it feels like.
Oh, they're not a co-investor with me. I'll call bullshit on them. I'm a bit more like Bonnie. No, that it is absolute greenwashing. I'm seeing it with Sequoia. I'm seeing it with a lot of folks.
I think it could be harmful in the long term. Potential. I mean, as opposed to transforming your approaches and your the investments that you make.
Again, the ultimate model, and this is Danny Kahneman's Nobel Prize winning work, should be completely data driven, irrespective of any optics. That is the point. You're injecting bias when you do that, and it's the bias and the anchoring that is what injects what's called decision process risk. And so the perfect world is you don't ever know what the entrepreneur looks like. You're just looking at data.
I think, Bonnie, you might have even written about it, because I seem to recall that there was something, a year and a half, 2 years ago that you might have put out around that. It seems, because I remember at some point I was thinking, oh, there's somebody else, and if anybody was going to be at it, it was going to be you. But I remember there was like somebody else who thought that was a little bit off. I do hope we continue to see some transformation, and maybe that's a step, and you need a step. But I hope that we see some larger transformation.
I know, I did put that link about how Google is giving up on AI, and the real elephant in the living room is age. I don't care about diversity, anything. It's age, and you mentioned that earlier.
Yeah, even for me, I kind of never was at a comfortable age. I was the youngest founder when I got to the Valley. Everybody was from Xerox. Nobody remembers that, but everybody, And so when I got to the Valley, it's strange to say, I was in my late 20s at the time, and I was the youngest person in every room I went into. And then, and I was always uncomfortable. And so I wasn't part of, and I knew, like, the next phase, the next generation, which would have been like I'll even include Elon in there, but like Sergey was there. They were already building, but they just had a blank bar on a screen. There was nothing there. So they were about 4 years behind. That generation, transformed everybody's view of what an age of a founder was. But I was always the youngest person. And then suddenly I was too old. Like I was in my 30s and I was already too old. And then now, I moved into venture, so I guess I'm okay. The lifespan seems to be a little different, but for most of my entrepreneurial career, I was super uncomfortable.
But I wanted to say on when you mentioned like they're creating other funds, I just thought of this idea because YouTubers are also, not that I am one, but are advised to create more like channels. I think it's also part of getting more investments or part of like a marketing strategy, increase more credit, or like Procter & Gamble, they have a lot of brands, like a lot of, because it's like you don't always want to be doing the same thing or investing and buying from the same company. Then the purchasers or whatever, or the investors want to go and diversify. And in a way they are diversifying, but they don't realize, because the guy at the top is still making the money and all the others are playing their game.
It's a great
So
point, though. It's a
maybe I
great
don't
point.
know. It's
No, I think it's a great point. I hadn't
sales
thought about it.
strategy.
It kind of goes to what I was talking about with founders understanding what funds are doing. We don't really do a ton of that at Quake, so I'm not as, we haven't really been focused on trying to. We always kind of knew we were going to be of a certain size. We never really envisioned being this, huge thing, and in terms of capital under management or number of funds or any of that. So, but it makes perfect sense. I bet you're right. It makes,
Of course.
yeah.
Regis McKenna was the guy, I know Bonnie remembers him, but he was the guy that brought marketing to Silicon Valley and branding and messaging and all the thin slicing that the advertising industry understands to mobilize money. And that influenced the venture industry. He became a consultant to a lot of the funds 30 years ago. And that was where we had this sort of spin injected into the entrepreneurial narrative, is because Regis was so powerful, and but it's just bringing it the manipulation of the limbic brain, a la advertising tools, to funding innovative companies. Spin became so important, and thin slicing. That's just thin slicing, right? So you can find a market niche that may be untapped, that you can go dominate the narrative and the messaging, so you can mobilize the capital, right? You can sell what you're selling into that niche market. And it's maybe selling securities into that niche market of investors, but it's all about that sort of advertising and marketing driven limbic manipulation. And that's where biases can be manipulated and mobilized.
Yeah, well, founders have figured out too. That's the thing VCs need to figure out, because I mentioned that again before we started recording, but founders know how to, we call it the jazz hands, right? They know the words to use. They know the magic phrases that we're looking for. And so they can navigate our due diligence process pretty well. Matter of fact, I don't mean to, it's not so much trying to pick on a culture, but we figured out that we were getting a lot of really, really insanely good applications out of India at one point. And we figured out that one of the universities there, they had kind of hacked our methodology and on our AI side, which was, so we were having, their founders are, first of all, that brings another thing up. I'll take an intro from a founder over an intro from another VC, every day of the week and twice on Sunday, because the founders all talk to each other. They know who's hot. They go to all these, they're kind of, there's just a much better awareness. They're going to a lot of these key events together, and they kind of know who's getting buzz and getting follow, and they're authentic with each other, I think, by and large, more so than they are with venture. But because of that, they can hack our systems too, because they're all talking to each other, and they know how to talk about exits, and they know how to talk about, a variety of different topics that maybe we're focused on. And so we have to be very careful, in terms of that pattern matching that we use can get us in trouble.
And actually, I heard about the India story, and I work with a lot of people. So again, not to pick on the culture, but the story is famous. And then the US investors were asking for like pre-diligence, etc., from a lot of the pitch states, not India. And I heard this number. It's also crazy. Only 70% after a successful pitch, only 70% of them don't get the funding because they don't actually pass the diligence. Right. So it just also shows talk is cheap on both ends, but what you do, does not always match what you say. I mean, what you dream to be and what you are can be different things.
May I ask a question before you continue? Can I ask a question? Can you unpack what due diligence looks like? What's a standard or a basic due diligence? What does that look like?
So I think it varies from, I don't know that there's a standard, but I can say that there's a lot of elements that are consistent. So there are a lot of things. In our case, and again, I think there are other funds that can talk about their process. In our case, we basically send to the founder what we would call an application, for lack of a better term, which collects data like who are the founders, what are their prior jobs, what's the product, what's the problem you're addressing, what's the, you know, what are some potential competitors in the market? You know, there's a whole series of things. It's about a 4-page document. Now, a lot of funds don't do that, but we used to do acceleration when we started. We were an accelerator. We still, I guess, technically are, but because we're all remote now, we're not attacking it that way. We're more of a very, 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 very active investor. So by that, I mean, like, I was looking at our Slack channel the other day. We had 70,000, almost 80,000 Slack messages with our founders over the last 5 years. So, you know, 1,300, 1,400 Slack messages a month, not counting email and text. So because we're so active and we're involved in helping them on strategy and everything, we collect a long form application. Other teams do it differently. Obviously, we like to see a pitch deck. The application for us, Alicia, is really, I think that there was a really big disservice done to founders years ago where some VC said you don't need a business plan. And the business plan is not for me or for any other VC, it's for you.
That's right.
And by the way, just writing things down forces you to refine your arguments. Like, you will find weaknesses in your own thought process and argument by just putting it on paper. But we use the application to kind of replace that, because many founders now don't have a business plan, and we want to know that they've thought through some of these things, but also allows us to collect data. You need to have basic stuff in your data room. We do a series of 4 interviews, 3 to 4, depends. 2 by phone. We used to do 1 in person, but now we do, you know, everything by Zoom. And then, you know, I guess in terms of your data room, you're definitely going to want to have, obviously, your pitch deck. You probably aren't going to have financials depending on your stage, but you might have the ability to create projections, and certainly your understanding. Our case, we are investing early stage, but most of our deals do have quite a bit of traction. So most of our companies do have some level of financial, both projections, but also performance metrics. They've actually been working at it a little bit on their own. And if you've got key things about, you know, you kind of look at where your strengths are. If your strengths are on your team side, then you want to have a lot of focus on your team. If your strengths are on your distribution and partnership side, because you've got kind of unique relationships with some other big names or partners, you want to have some information on that. If you have key customers or accounts that give you credibility there, then you want to have some information like that in your data room. You basically want to put your best foot forward where you can, but every fund you talk to is going to have, we have a checklist we share with our founders that kind of says what we want. You know, again, if they have customers, we're going to call them. So, you know, and we're going to talk to the founder, we're not just going to reach out. And so sometimes that's a delicate issue. We have to be careful about that. VCs are pretty sensitive to that. So if I was building, the first thing I would do would be, before I started anything, I'd build a business plan, because they're so incredibly helpful to me as a founder. And then I'd build my pitch deck. And then I'd start talking to VCs about my message and figure out what kinds of things each one's going to have their own requirements. Curious what others on this call maybe require in their diligence. It's not going to be, you're not going to be a public company. You're not going to have a huge data room. You know, my data room has 100 items in it. Yours is going to have like 8.
Alicia, I think what he's touched on, which is a really important point, is there really isn't a standard, right? It is very eclectic to the hot buttons for the audience you're pitching. So it's really hard to know what's the right pitch. It's basically the right pitch for that audience. And then another VC, it may, you know, and that's where the homework and the due diligence. And that's, again, from my observation, that's part of the challenge of the venture industry is that, well, I use the word unprofessional, and forgive me, Glenn, but you know, the venture industry itself is the last financial services industry where the participants, the GPs, have no professional standards or requirements they have to adhere to call themselves a VC. They don't have to go through training. They don't have to be educated on what is the right due diligence things. It's all just a free form. And that's why you have so many investors that have to follow somebody else, because they largely don't know what they're doing. They don't know what they're looking for. They're looking for social signals elsewhere, somebody else validating the due diligence process, and then they jump on a party round. That's where, if you look at the numbers of transactions, not as much dollars as it is numbers of transactions, that's the majority of the behavior. So for an entrepreneur to say, this is how you pitch a VC, that's just generically going to be inaccurate because every one of them is different. And they're largely driven by social signals, not their own critical thinking, processing of due diligence information. Now, Glenn's a data guy. Obviously, he stands out. And the evidence of that is the success rate, the survivorship. That's one of the criteria, Glenn, is their skill in what you're doing. Whatever you've architected, that is one of the data points of skill, is the evidence of what's in the consulting world. It's called literally, it's called batting average. What's the batting average of the companies that survive after certain periods of time versus don't survive?
Well,
And
interestingly enough, so at least I know that I'm on the right path. So I have my business plan halfway done. My pitch deck is done. So very interestingly, I appreciate you sharing that, because what I'm doing, I'm a person that I like to have my ducks in a row before I go off and have conversations. I'm not coming to some place not prepared. And so having listened to a number of investors over the last, I would say, last 9 months. It's very interesting. You are absolutely correct, Joe. Everyone has a different idea about how they want to do things and what they view or believe is the correct way for a founder to approach them. I mean, between the very simple of, do you cold call, cold email, or warm email, all the way down to, okay, well, what are the requirements that you need to have to even have not even just an introduction? Can you even submit an application on their website so that you actually proves you're viable? It almost makes, I will say, from a founder's perspective, the process of trying to attempt the journey of fundraising, it almost makes you second guess your intelligence. It makes you second guess your ability to run a business at times, because everybody's requirements are so different and diligent. And I get it. Business is business. So let's not act like it's not business. But there is something to be said with, if you didn't have any formal training about how to be an investor, you can't be a formal trainer of me who knows my business.
Thank you.
And so with that said, you're not going to dumb me down or dim my lights because you think that I'm incapable of running a business. I'm more than happy. I have bootstrapped my planner business since last year to get to the point where I'm launching in November. So I'm clear about what I can do. There's some things that I don't know how to do. So I'm always very appreciative of all the conversations that I've had and, the pushbacks that I've received and what have you. But I gotta say that the process, almost makes me feel sometimes like I am the dumbest person in the room. And I'm like, I know that I'm not. I know that I'm not.
If you go into every meeting, I'm sorry, Bonnie. If you go into every meeting with the thesis that investor doesn't know what they're doing.
Yes.
I'm dead serious.
Yeah, no, I am. That's why I appreciated what you said, because that now makes me feel a little bit better, because I had one where I was like, did he just hand me my head a little bit? Okay, so I mean, and he wasn't rude. It was just the pushback that I got. And I was sitting on the train. I'm in Chicago, and I'm sitting on the train, and I'm heading back home, and light bulbs started to hit where I was now solving. Now I knew exactly. It's like his pushback and his inability to see what I was doing now made me it didn't make me change my mind, but it solidified that I knew I was going in the right direction, because now things started to click in my head. I'm like, oh, he said that. That's why I'm solving this problem. So all of that to say is I appreciate Glenn, you sharing your due diligence process is
I'll send you
important for me, because I need to know whenever I decide to take this forward for my technology, when I'm fundraising for my technology, then I need to know what it is that I'm going to have prepared and ready to go. Whoever that fund I go to or whoever that investor I go to. My goal is I'm hopeful that my first launch will pay for my technology and then I won't have to worry about it. But I recognize that there isn't nobility in not asking for help. So thank you. I just appreciate it. Thank you so much.
You know, I just wanted to add one thing, Alicia, that a pitch deck is a work. I hate to break this to you, but a pitch deck is a work in progress. It is not.
Oh yeah, no, I completely know. I completely know.
Okay.
I have no. So it's so funny. I just changed my pitch deck, and then I have a mentor that's an investment mentor. He doesn't know that I've claimed him, but he knows that I've claimed him. and so
You gotta have them.
Yeah. Oh yeah, I have. And I will say thank you to Bonnie because I picked up one of the investors that I spoke with. He did take the time out to go through my pitch deck with me, and he did help me. So I'm still connected. I told him I was claiming him, so he can't lose me. But I have a friend, Marvin, who went through my pitch deck, and he sent me notes of all my slides on what I need to change or what I need to answer or where I can make a tweak. And so I'm going to go through that today so I can get that together. And, but yes, it is a working document. And I also, from Chris Haskell said to me, you're going to have different pitches for different people. Yep. So I recognize that I'm going to have, at some point, I just wanted to get this first one. I want to get this first pitch deck done so I can stop looking at it, and then I can start working on the additional versions of it. But yes, yes, June, Chris is he is fantastical. I told him at the end of our conversation, I said, "Can I keep you, please?" I was like, "No, I am just gonna keep you. No, you cannot be rid of me. Like I need to keep you," because he was wonderful. He was really wonderful. So
I got two founders in Chicago. You're in Chicago. I definitely want to connect you with there. They happen to be Black female founders. They happen to be two of those that have raised over $1 million, but their journey, you know, their experience trying to raise money in Chicago and then raising money elsewhere and then coming back to Chicago, and now everybody wants to give them money, and kind of they've just got a lot of things that I think could be really helpful.
Oh, that would be awesome. That would be awesome.
And they're phenomenal. They're certainly, Jasmine is one of the best storytellers I've ever met, and that's a really important, whether we want to acknowledge it or not. Doesn't really fit where Joe and I land on the data side, but if you're talking about success raising money and success selling products, storytelling's a big deal, and Jasmine's amazing at it.
Yeah, I would appreciate that. Thank you so much. I know for me that because of my background, I think very linearly, so I could tell a story. I can always tell a story. But the thing that I found, I practiced my pitch once, and I could even feel for me that it was too cerebral. And so I know that I have a lot of personality, and my personality was out of it because I was so busy trying to share the facts, because like you, I am a data guru. I love, like, the numbers need to make sense. So like when I figured out for my industry, just a 0.5% of what I could pull from the market if I'm successful, I'm like, oh, this is good. I'll take it. I'll take it. So it's one of those things as I'm learning new things, as I'm picking up more information, it's fueling me forward with knowing that the direction I'm going with my company it is going to be a game changer if I get it done. And so I'm now determined to get it done because I know where it's going to go. I absolutely know where it's going to go. But yes, introductions are wonderful. Thank you so much.
Yeah, definitely. I have a few comments, but I think Zarin had something to. Yes.
Oh yeah, just a quick. I just want to sometimes also some maybe very basic things, but let's say where your head office is registered. For example, in Germany, there's a law you have to put on your website, impressum, and it's like a legal address. You may have a few places in the world that you are, but where is your head office, where the money is going, what is your bank account, are the founders, maybe a little background check, like meaning are they in some kind of list that banks get lists like where you should not be working with this kind of people. Europe, there's a European list, FATCA list, US list. So this kind of background checks is also important for due diligence.
Okay, that I appreciate that. I mean, I think that as I've looked at other founders that are wildly successful now, I mean, everybody's been broke at some point in their life. They've managed to struggle. They've had bankruptcies, they've had divorces, they've had failed businesses, and then all of a sudden, out of nowhere, they find this unicorn, they create this unicorn, and the next thing you know, everything that's in their past is completely gone. But I think the issue will always be, if you have failings, it's how you manage to pull yourself out, not necessarily pull yourself out of it, but it's how you react to it. Okay, so things happen. So how is it that you made it better? Did you learn your lesson? Did you repeat certain things? Did you go back to, if you're still going to be repeating things, especially from a financial standpoint, then that's a problem. So thankfully for me, I spent the first 10 years of my working career in banking and finance. So when it comes to money, I don't fool with money. I had someone say to me, oh, you should just say that you're $1 million pre-seed. I was like, but I don't need $1 million. And that makes no sense. Just because I can say that, that makes zero sense for a person that can look at their checking account and know what check hasn't cleared.
Oh,
that makes zero sense. I can't in good faith do that. So I'm like, I want to know that if I fundraise, that it's for the vendors. I have my invoices from the vendors that I want to engage with to build what I'm building, and then my runway. I don't need any more. Having extra, it makes no sense. It just makes no sense. I don't care that $1 million to an investor is $2 or it's a pair of shoes at Nordstrom's. I don't care about that. I'm like, I'm only going to fundraise for what I need to get me where I'm going, because I want to give that money back ASAP. I want to exit and give my money back ASAP. So I appreciate that. I will at some point, I think in January, I will start building my due diligence. I'm going to start, would you suggest, is there a place where I can go to look at, I know that it's funds, every fund is different, but a benchmark or a level of due diligence listing or a checklist. Actually, Glenn, if you could share would you be willing to share your checklist?
Yeah, I'm happy to.
Because your checklist sounds like the most it sounds like it will.
It's going to be more. I'm going to tell you right now, we always tell our teams that our checklist is, it's kind of the aspiration. So I mean, I'm not saying we're great or anything. I just mean that we ask for more stuff than most people are going to ask, and we know you won't have all of it. Our checklist is designed for our founders not only to get through our diligence, but to get to the next round of capital, and that next round of capital is much more serious.
Oh yeah, well when you get when you get to seed A, seed B, if you get, once you say seed and there is no pre to it, you already know the seriousness of
but
that.
I can send it over. It's in our Dropbox files. I'll pull it up and send it over right after, and I can share it with everybody here. I don't care.
Yes, I'll be happy to get that as well. And just to clarify, when I meant like the background, I didn't mean like people can go into financial difficulty, bankruptcy.
Oh yeah,
I meant like there are certain like international lists, like even for a venture capital fund, if you get money from such an investor, even they have a lot of money, you would be in serious trouble if you're funding a certain individual with, I don't know, like on weapons sanctions list, etc. I mean, it's not something related to you, or I don't think so.
So Zarin, so interesting you say that, because I have an investor that I've been talking with for a few months that's been watching my journey, and he is overseas. So I would love to find out what he actually is doing.
Actually, there are companies whose job, their specialty, like intelligence companies, their job is to check backgrounds. They're not like legal or financial. They're more.
Yeah, no, they're just looking, because there's one thing that I'm learning is that you know, anybody can tell you that you're interesting and they would love to invest in your project. But, you know, when I smell shiesty, and that's what we call it in Jersey, where I'm from, if we smell shiesty, if we smell like there's something wrong with you, yeah, we're looking at you very cautiously. And so what I've been hearing from him, things that he's been saying, doesn't match up a little bit.
Yeah, be careful.
Yeah.
And there's
Yeah,
also
this is-
frontmen, like they're fronting for some kind of money or whatever behind, but you know, it's very important what's the source of the money, not the front guy.
Yeah, because he keeps asking to, because we've been talking, and we did have a meeting, and it was really a good meeting, and I felt good about him. But I had a small red flag raised, because I asked him, did you see my pitch deck so that you can give me some feedback? Because that's how we started this conversation. And he was like, yeah, I've shown it to a few other people, and they're like, if you can get your product launched, then we'll definitely invest. I can see the analytics to my pitch deck, and he did not look at it.
Oh, you know, I want to see if anybody else in the room has a question, and I want to give Glenn a chance to respond as well, since he is our guest investor today.
I actually just have a few comments from what Alicia was just saying. So first of all, be very careful on any capital you take, because that's like it's a marriage. And you can't get it annulled. So you're going to be with them for a while. And by the way, scams are very much on the rise for everybody on the call. Some of the VCs have probably already seen it, but scams are on the rise for startups that have a little bit of money. There's a scam right now coming primarily out of, well, we've seen it coming out of Singapore and mostly out of Singapore, but basically we've had about 5 or 6 of our teams been approached. And what they'll do is they'll offer money. There's not a lot of diligence, but you have to get a insurance policy for against failure. And this is something you can, investment failure policy you can get in a well-established big company, but it's impossible to get one for a startup. So then they're basically saying, but I know somebody who'll do that. And then you buy this policy and then they disappear and you get no money. So if you've got a little, it won't happen unless you've got some money, but if you've got a little money, scams are on the rise right now. We've seen it over the last 6 months, have increased dramatically. Couple quick things. I would say on experts, you mentioned experts, Alicia, you've spent thousands of hours thinking about your problem over whatever career or history time. You're going to sit down for lunch or breakfast or something with some expert or somebody like me who does, a lot of investments, done a lot of startups. We want to be helpful, and we're going to try and be helpful. But there's H.L. Mencken has a quote about, kind of like quick, brief answers can be really pithy and sound really good, but they're generally wrong. It's much better quote than that. But basically, experts want to try and help, and they're going to try and provide value in 15 to 20 minutes, but they have spent almost no time on your business. A lot of times they can get lucky and provide some real value because they've got the perspective of time and experience, wisdom. But be very careful with expert input, because you've spent a lot more time thinking about it. I'm not saying you shouldn't take it, be flexible, absorb that data, use it, but understand they're trying to provide value, but they just don't have the time, on site that you've got. The other thing I would say real quick is in terms of diligence, one of the things that I see a lot of teams miss that is really important to us, I'm always looking for feedback loops. I'm always looking for how the founder is validating their thesis. Like, what kind of engagement do they have with their customers? Like, because a lot of times you don't have revenue traction. So what other kinds of things can you do? I asked for levels of proof, market proof, product proof, different kinds of proof, right? And one of them that you can do is you could be talking and building feedback loops with your limited pool of customers. When you talk to Jasmine, who I mentioned there in Chicago, they were genius. She and Denise were genius about how they built feedback loops with their customers, their early customers. And that ended up getting Morgan Stanley to buy in and invest because they had data on the customer side. And so I think feedback loops are hugely important. And finally, I would say, just for everybody on this call, why I love founder referrals. If you want to get in to see a VC, look at who they invested in, mine your LinkedIn data, find some way to connect with some of the founders that they've already invested in, get one of those founders to make a referral, build a relationship at one. You don't just ask for it, build a relationship, get a referral. Why is it so important, I think, to get a referral? Not even just the stuff I said earlier. What VCs sometimes, I think, fail to recognize is founders hate referring other companies. They may say otherwise, but this is just absolute truth. Every dollar that a VC gives to somebody else is a dollar not going to me and my startup. I knew that when I was building. It's not necessarily true, but it's the view. It's the viewpoint. And so when a VC says, I'm going to have this startup look at this potential opportunity, that's the worst thing a founder can hear, because very rarely, first of all, there's almost no upside for somebody in their portfolio to recommend investing in another company. Like, that's got almost nothing but downside.
Yep.
And they're not going to get anything if that goes well. And so founders are very reluctant to say nice things about deals that they're asked to vet, and they're very reluctant to refer things. But if you can build a relationship and get a referral from somebody they already invested in, there's a level of trust there. I think inherently most VCs understand that that's a difficult thing for a founder to do. And I think that's about the best way that you can break down a door. So to go to that point, do that. And then Bonnie, that's all I have. I had a series of points for Alicia. That's the ones I had off the top.
What about general advice for everybody else on the call? Does anybody else have a question?
Yeah, I do. A couple of them for Glenn. First one is a bit narrow. Glenn, to what degree, if at all, are you guys sensitive to the QSBS tax incentives around either 1244 or 1202? Do you use those or filter on those or care about those?
No, we did look at it. We talked to our team. So, we use, like everybody in our space, we have third-party administrator, we have tax people, and we have an auditor, right? So we get all and legal, and so we get all the notices. So we definitely pay attention, and we looked into that, but we decided that from a thesis perspective, we actually thought, Joe, that it was kind of again, it's not necessarily a bias, but it would drive us to move against maybe some of if our goal is to really pick winning investments over, and again, there was one thing I was dead wrong about. I was dead wrong when I started this. I told a lot of our LPs that we were going to get to exits a lot sooner, and we've done fairly well. Like I said, we're one of the top rated funds, top 2% for exits for our stage, but I thought we were going to get a lot of exits in year 3, 4, which, by the way, is an interesting challenge, for cap gains and some of the other stuff. But I thought we were going to get to a lot of exits in year 3, 4, and we're going to look like everybody else. We're going to get to exits in year 7, 8, and beyond. I mean, it's not going to be, because founders aren't actually as good at that as I expected them to be. And that's not really a rub on them. That's just kind of how my career had progressed and how good I was at it. But since we now have shifted to a long-term view, and we're reviewing kind of like, from our perspective, just get the best survival rates, more at bats, deeper in the pitch count.
Yep.
We're going to get we're not hunting unicorns, but we know we're going to get them, and we can see them now. We've got them in every fund. We've got a fund maker in every, one investment worth the entirety of every fund. We feel like we've got that in every one of our funds. And then we've got multiple others that are that we think have unicorn potential. Because that's now the strategy, we do not make bets based around policy, legislation, tax policy. We've moved away. We started to, and we decided that it didn't fit with our data-driven approach. So okay. I'm curious if you agree with that, but that was kind of how we attacked it.
Yeah, well, I don't want to spend too much time on the tax stuff. I'll do that offline with you because there's some movement on that industry wide. The other point is really just to reinforce one of the things you said about entrepreneurs. There's nothing in it for them to make that referral and to put the reputation and their personal brand at risk in the eyes of the investor on their cap table. That's a really important concept to understand. It's actually called prospect theory. Prospect theory is what Daniel Kahneman won the Nobel Prize in Economics for in 2002 as a psychologist. It's called prospect theory. And this is just understanding human beings. You framed it perfectly from an entrepreneurial referral standpoint. It's the same with investors. And what prospect theory says is the prospects for loss are twice as impactful in decision-making processes than the prospects for gain. I'll say it again because I can't stress it enough. The prospects for loss are twice as impactful in motivating behavior than the prospects for gain. So if you're pitching an investor, you've got to have that as part of your messaging tone. Prospects for loss. Now, loss of what is the question? It doesn't mean loss of money. It could be loss of reputation.
Credibility. Yeah.
Credibility, right? Investors, think of the headline risks of all those investors that invested in Theranos, right? Their loss was brand and credibility, not money. Betsy DeVos wrote a $90 million check without asking for audited financials. If you look at the narrative on what that transaction was, the gal that she relied on, this biotech person, purportedly says, we just don't want to miss out. It was FOMO. Fear of missing out is a fear. Okay.
It's a huge issue in our space too.
Huge issue. It's human behavior is my point. This is a universal truth. This wasn't just framing investment decision-making for prospect theory. It's under any decision-making process. And so it's just an important tool. You really gave a wonderful illustration, Glenn, but it's also relevant when you're talking to investors. Anybody, it's the fear of missing out. Customers.
You know, it's funny.
It's a prospects for loss is twice as impactful as a prospects for gain in their decision-making process.
You mentioned something that it's funny because I was talking about how founders need to understand what's going on in the mind of the VC. And Bonnie, I don't know if it would have come across your plate or anybody else here. I'm reluctant to name names, but there was a deal that came out of what's Mach 37, the kind of cyber and military accelerator down in DC, Baltimore area. They had a deal that I came across our plate, and it was growing at an insane rate. We couldn't get our diligence done in time. They were like, everything had to be done super fast. There was this massive FOMO around it. I talked to a big fund that was investing in it. They basically told me I was an idiot, that we wouldn't sign a check and move fast enough. That deal is now one of the top 5, right there with Theranos. The founder is going to be sentenced this month. One of the top 5 scams, $187 million scam, cooked books, worse than Theranos in many ways. But I can remember for 2 years, that was our first year in business. I can remember for 2 years getting calls from some of the investors on that thing, like, oh, you should have done that. And I saw entire funds raised almost entirely on that one investment.
Yep. That
was total bullshit.
Bullshit.
And I've seen, and those funds raise their funds, and so there's not a lot of penalty on that side of it, right? You know what I'm saying? Like, but if you don't follow your diligence, now they've paying a penalty. Now their credibility is taking a massive hit. But
yeah.
FOMO is, I was just talking about that with a group of investors the other day. That's like, I think one of the things I see funds constantly vacating their process.
It is, and I saw it in the money management. Again, the parallels to what I see in the venture world are myriad, because you mentioned something earlier about that I didn't get. I won't try and backtrack on it, but it was brilliant because I saw it in the public markets with, when you're talking about those Indians reverse engineering your algorithm.
Oh, yeah.
Well, that's what the Enrons did, and that's what the Tycos did, and all these other publicly traded companies that literally knew that the investment bankers of Wall Street were listening to the analysts, so they reverse engineered how you can get an analyst support on your stock. And they were able to raise.
I did a lot of that when I was running public companies, Joe. I wasn't immune to that myself as an operator. I figured that out super fast. I figured out how to hack the acquisition game.
Right.
I figured out how to do creative deals.
There's a phrase that is really, really important that I adopted, and I don't know whether Buffett was the original one to say it, but I give credit for me learning about it from one of his quotes. And that is, I don't need to own all the stocks that go up. I just want mine to go up.
Right. I'm gonna end the recording. I'm gonna thank everybody. We can stay on the call, but because I'm really enjoying this conversation. But thank you to everyone for attending, and thank you, Glenn, especially.
Yes, thank you, Glenn.
And
I'm Bonnie, I was joking with you before that I didn't realize these were in person.